Hello, team members. Welcome to webinar with Samco and their new offering of Samco FlexiCap Fund. Uh, the FlexiCap category, if we will talk about, which was introduced in November 2020, and we have seen that since then the category is doing very well and has grown up also in terms of AUM. And in today's, if we will talk about, then around 2.2 lakh crores of this particular category with 28 funds in this particular category. And Samco is one of the new AMC which is coming out with its new offering in this particular space. So I will not take much time and I'll introduce our today's guest, Mr. Jeemit Modi, founder and director, Samco Asset Management Private Limited. So just to give you a brief about Jeemit, Jeemit is a chartered accountant and CFA. He has experience auditing large firms and a deep first-hand understanding of the functioning of large multi-billionaire dollar business. So Jeemit, I have just gone through the Samco presentation, and I have seen very interestingly few theories or a few words like the portfolio will be a concentrated portfolio, and the fund is focusing on active share with international exposure in flexi cap category, which is definitely a unique feature and extremely cost efficient. So these are the things which actually attract or can attract lot many investors, or and they can look forward for this particular fund. So Jimit, I'm just handing over to you. If you can show us what is the different or unique offering, Samco is coming out with within this particular category.
Okay. Thank you so much, Ritu, for your kind introduction and a brief background about the industry as well. So I think what I will do is that, in quickly in about 20-25 minute presentation, I'll share with you what our investment process is. First a brief background about Samco, our investment process, typically what the strategy of the flexi cap will be, and then most importantly, how we are going to be different from the other funds in the category, and how we will be in a position to create a lot of wealth for investors. So just by way of a brief background, the group was founded in 1993 as the Samruddhi Group by our chairman, Shri Mr. Vipul Modi. He's a rank holder chartered accountant, comes with over 30 plus years of experience. In fact, has been a veteran in the capital markets business, where he was the member of a few SEBI committees like the delisting committee, primary market advisory committee, and has helped shape a lot of SEBI reforms as well. Typically, as far as our journey is concerned, so as a group, while we've been around for about 30 plus years, we made an application to SEBI to be a mutual fund in 2018. 2019 we got in principle approval. 2021 we got final approval, and here we are launching our first scheme. The NFO did open yesterday, and which will close on the 31st of January. Typically, as far as our board of directors is concerned, so which is very critical, we try to make sure that we have a world-class governance structure in place. So for the Samco Mutual Fund, we have Mr. G.N. Bajpai, who's the former chairman of SEBI and LIC, who's the chairman of the board, Mr. Prabhat Kumar, who's a former cabinet secretary, Mr. Gedia and Mr. Modi, who are reputed chartered accountants. So collectively, the trustee board has experience of over about 100 plus years. And even on the AMC side, we've got Mr. Ashok Kakkar, who has been the former ED of SEBI, Mr. Ishwar Nayak, Mr. Kanu Doshi, who has been a former chairman of Nippon AMC, Motilal Oswal AMC, and Edelweiss AMC, and myself. So I think collectively what we've tried to make sure is that, we've put forward a very strong governance structure and a very strong board of directors in the interest of investors and their protection of their interests. Now, coming to our core investment philosophy and process, we call Samco Mutual Fund, a stress-tested mutual fund. So typically, we are trying to bring in a new concept of investing for Indian retail and HNI investors. And the concept of stress tested investing is actually a banking and regulatory concept. So if if you are familiar, a lot of banking regulators put banks to stress test to evaluate, whether a bank will survive in a bad time or not, whether a bank will have enough capital adequacy or solvency to meet depositor obligations or not. So we are applying a similar concept in the investing world, and where we are saying that typically as a part of our stress test process, we are trying to evaluate two things: that will a company survive or not, uh, because the lives of companies in generally have become smaller and smaller because of constant disruptions, right? So between 2000 and 2020, even in the Sensex, out of 30 odd companies, only 6 odd companies are now common. In fact, 24 companies have got churned. So it's very important to stress test whether a company will survive, and only if it survives will it pass the stress test. And finally, what second thing, the most important thing that we try and check here is that can a company make an above average return on capital employed or not. So I think what the most important aspect in equity investing, we keep start taking our eyes off the price in terms of EPS and PE multiple and all things that typically do not drive long term performance. The only thing that matters is, can a business make an above average return on capital employed, which means the benchmark that we seek is 25%, which means that 100 रुपया अगर कंपनी में कैपिटल लगा हुआ है, can it at least make 25 rupees or not? On 100 rupees, can it make 25 or not? And in essence, can it be a true compounding machine by reinvesting those earnings back into the business? So we've designed a 6-faceted framework. I'll come to that, but just quickly, I want to show you this particular slide. So this is basically in the market, we are familiar with growth and value as two strategies. This is the S&P 500 for the past 100 years. And if you look at, if you would have invested in 1917 at the lowest PE multiple, and sold at 1999 at the highest PE multiple, even in this period, the annualized CAGR or the stock price was only 2%, which is 20% of total return. So, we very often say the value strategy, but reality is that evidence shows that value strategy does not contribute to more than 20% of all return. In fact, 80% of all return has actually come from earnings growth, which is nothing but companies making a high return on capital and reinvesting it at a high rate. So we are trying to capture 80% with our entire stress tested process. And these are the 6 facets of our stress tested framework. First are reinvestment and growth, regulatory stress test, competitive pricing power, corporate governance and leadership stress test, cash flow stress test, and finally balance sheet stress test. So for a company to qualify as a company that passes the stress test, it has to pass all 6 facets of the stress test. Even if it fails a single facet, it qualifies as a company that failed the stress test and will not be a part of our investment universe. So I'll just give you quickly 2 examples. TCS is a company that passes our stress test. As a company, it makes 48% return on capital employed. Even if you put it through multiple levels of competitive intensity stress test, it will still make 31% even at the 20th level. Now, on the contrary, if you look at something like a Reliance, the return on capital for a Reliance is only 10%. Now, even if and typically it's a price taker in most markets, even if it becomes, typically competition goes up in the industry that they're operating in, the return on capital employed would fall from 10% to 2%. Now, if the business makes 2%, as shareholders, we are not going to make a materially different return. And we've seen that in the past, where for a period of 8 to 10 years, no return has actually practically been delivered by Reliance. So that is a business that fails the competitive stress test and consequently all the stress tests, the overall stress test framework. Now, as far as our investable universe is concerned, there are 67,000 companies that are listed globally. Out of these 67,000 companies, only 125 companies pass our stress test. These are 40 odd Indian companies and 85 odd global companies. So in the Flexi Cap fund that we discussed today, we will be investing in 25 odd businesses out of this universe of 125 names. And we'll come to the strategy in the next few slides. Now, the one more concept that we are truly pioneering in the industry is that, see, our aim is to be a truly different mutual fund. So we are going to be the first AMC in the industry that discloses active share. Now, first, why are we disclosing and what does this mean? Today in the industry, more or less, all fund managers have become index huggers. So this phenomena is called, copying the index typically, where fund managers end up copying the index 70 to 80%. And then once you copy the index and you charge a 2% fee, you will not be able to get a lot of outperformance really. So what active share does is that it measures what is the percentage difference between the index's portfolio and your portfolio. So in simple terms, it measures the percentage differentiation in your portfolio. And if your portfolio is not at all different, then your active share will be 0%. If your portfolio is completely different, then your active share will be 100%. And our promise is that, we will make sure that an investors have a truly active fund when they buy a fund from Samco. So it's going to be truly differentiated. As Ritu said earlier, there are 28 funds in the Flexi Cap category today. And out of 28 funds, there are only 2 funds that are truly active. Most of the funds are in the index hugging or passive space really. So as I said, we will deliver a truly differentiated active fund. Now coming to the strategy of the fund itself, so we call it the Samco Efficient Companies Flexi Cap Fund. So it's a simple 3-step strategy. We call it the E3 strategy. Buy efficient companies at an efficient price and try and maintain an efficient portfolio turnover. Now, churn. So, and the goal with the fund is to be a fund that generates the highest risk-adjusted return, which is typically measured by Sharpe and Sortino. Now, coming to the 3-step strategy, first, buy efficient companies only. Now, what is the definition of an efficient company? An efficient company is a company that typically makes a very high return on capital employed in cash that can sustain it for long periods of time. So, in the Samco Flexi Cap Fund, out of the 125 companies of our universe, we will be investing in 25 companies. So, out of the 25 companies, 16 will be Indian companies, and about 9 odd will be global companies. So it will be invested in a proportion of 65%, 35%, run as a very high growth strategy. So because we are looking at businesses that not only earn a high return on capital employed, but can grow very fast as well. So just to break it up, looking at businesses with 25% plus return on capital employed in cash, adjusted for growth expenses and sustainable. So we are looking at companies that can sustain their return on capital employed. We don't want a company where 1 year it makes 0%, the other year it makes 100%, in between it will make 25%. You want a company that can make 25% with near consistency, 25, 24, 26. That's the thing that we typically look for. And from a look through metrics point of view, if you look at our businesses, these are far more efficient than the Nifty 500. So the Nifty 500 return on capital employed is about 10%. For us, it's about 24%. Gross margin is better. Long-term debt to equity is lower. Every metric is much better. And see, over the long term, the stock price return is going to mirror the return on capital employed. This is which is line item. And if you are familiar, in the Nifty 500, mota moti, the 20-year compounding has happened at more or less 10 to 11%. And for our businesses, typically the stock price CAGR has also been around the 24-25% kind of a level. So this is what we are trying to, these are the kinds of businesses that we are trying to buy. And what contributes to these better performances and sustainable returns? Typically, these are the key 7 drivers, and I'll discuss some examples. So so the kind of businesses that we invest in are businesses that make essential non-differable products and services. Let's take an example of Novo Nordisk. Now, Novo Nordisk is a global insulin pen manufacturing company. Now, all consumers who need to take insulin pens, 1 out of every 2 insulin pens in the world is sold by Novo Nordisk. Now, as a consumer, if you need to take insulin, you cannot defer the consumption that मैं 6 महीने बाद लूंगा या 1 साल बाद लूंगा. Unlike a car or in a real estate where you can take that call that nahi, abhi nahi, will take after some time. Now, because of this essential nature and this habit nature of the products and services, these businesses consistently generate a high return on capital employed. In fact, Novo Nordisk almost makes about 60% plus return on capital employed and reinvests 50% of its earnings back into the business. So it's a Norwegian company listed in Copenhagen. Another example is a company called Facebook. Obviously, we are all familiar with Facebook. We use 1 out of their 3 products in WhatsApp, Instagram, or Messenger. And typically, because of the habit of the consumers to come back on Facebook, the return on capital employed that Facebook enjoys can be sustainably high. The kind of businesses that we look for are price setters. So, these are market leaders who set the price of their products and services, and competition ends up following the prices that these businesses set. So Microsoft, Asian Paints, Crisil are some examples of such businesses. And we are looking at companies with very large reinvestment opportunities. So looking at companies where, see, this is where companies like an ITC, Castrol or Colgate fail, because making a high return on capital is not enough. You have to be able to reinvest it for growth. You have to be able to innovate products, and at an incrementally higher rate reinvest the earnings that you make. So which is where we are looking at companies like LTTS, LTI, Bajaj Finance. We are familiar with Indian names. Nvidia is a global AI chip computing company. Out of, so it's a $700 billion company, but still it reinvests almost 80 to 100% of its earnings back into the business. Intuit is a company that's a global accounting software company. Again, that is a company that's a $170 billion company, but reinvests all of its profits back into the business. So we're typically looking at companies with very large reinvestment opportunities. And finally, we are looking at companies with very high intangible assets. So what we are trying to do with this, in basically, if you look at a company like Alphabet, which is the parent of Google search, or a Costco, which is a wholesaler in the United States. Now, these companies have a very large intangible asset base. If I tell you, if I write a $500 billion check, and let's try and copy Google and recreate Google. With no amount of money, you can recreate Google, because the asset is so intangible that you can't touch and see and feel it. So unlike businesses like steel, cement, where you can, or hotels, where you can see an asset and it's therefore simpler to copy a particular asset. And because of competition being able to copy these businesses, the return on capital that comes back to mean. But in the kinds of businesses that we are investing in, that doesn't happen. So because these intangible assets could be brands, network effects, patents, installed bases, and as I said, these are very difficult to copy really. What will not form a part of the portfolio? Typically, no PSUs, no cyclicals, no investment fads. These businesses will never form a part of our portfolio. So the reason being that these businesses are subject to what is called the rule of 50-80. So which means that there is a 50% chance that a stock will fall 80%, and there is an 80% chance that a stock will fall 50%. So moti, what we are trying to say is that if you look at companies like Tata Steel, Tata Motor, SBI, if you look at the price pattern for the past 20 years, 100 rupees stock goes to 500 for Tata Motors, 500 comes back to 100, 125, 125 goes back to 300, 300 comes back to 100. So the price pattern is a yo-yo price pattern, and these are not the kind of businesses that we are interested in investing in. Now, this is extremely important. So, we say that there are two ways of making money in the world. One is you buy only the biggest companies in the world, which is what the Nifty offers you. So Nifty is a composition of 50 of the largest companies in India. On the contrary, our view is that the other way of making money is you only buy the best companies, which typically are our stress tested past companies. And the difference, price performance difference between the best companies and the Nifty companies is very, very large. Now, please understand, there's a huge difference between the biggest and the best. Companies like Reliance and L&T and SBI, Coal India, NTPC, ONGC, they are the biggest in the sectors that they operate, but they're not necessarily the best or the most capital efficient. The kind of companies, so typically that we are investing in are those which these businesses have performed with incredible consistency. So they've outperformed, in fact, 2/3 of the time. It's not possible to outperform all the time, but 2/3 times outperformance is excellent. So these businesses outperform 2/3 of the time. When they outperform, they're outperforming by a much larger margin. When they are underperforming, they're underperforming by a smaller margin. And that is what leads to a net positive expectancy return of 1.62% on a monthly basis. So this is the alpha that these businesses have typically generated on a month-on-month basis. Which validates our thought process that investing in the best is far superior than just investing in the biggest. Now, the step 2 of the strategy is that we will try to buy these businesses at an efficient price. See, we don't believe in a strategy where you can buy good businesses but pay exorbitant premiums. So in step 2, what we are trying to do is we're trying to see that obviously our companies are much better quality, but you have to pay a reasonable premium for them. You cannot pay an exorbitant premium. Now, how do we measure that? So typically the first and most important thing is that the long-term price return or the stock price return is going to be equal to the return on capital employed. This is an old Charlie Munger saying, which says exactly the same thing. So the kind of business or the kind of fund that we intend to run is like company A. As you saw earlier, our businesses are 24-25% return on capital employed businesses. In this company A, typically because the compounding is happening at 20%, even if you buy it expensive and sell it cheap, over a long term period of 5, 10, 15, 20 years, your stock price return will mirror the return on capital employed. Similarly, if you buy something like a company B, where the return on capital employed is 10%, and even if you, which is like the Nifty, so Nifty's return on capital employed is 10%. Even if you buy it cheap and sell it expensive, still your stock price CAGR will be not more than about 10-11%, which is what has happened in the case of the Nifty, because the compounding itself in the book value is happening at about 10%. So the kinds of businesses that we are intending to buy are businesses that are in a continuum, that are in secular trends, where any investors, even if they invest in any 3, 4, 5 year period, we could make a substantial return because these businesses perform well on a rolling return basis. Now, and how do we value companies? So we value companies on our proprietary metric that we call the free cash flow yield. So what the free cash flow yield does is that it measures what is the yield that we are getting for price that we are paying. And once we get the yield, we compare that to the rest of the universe, to other stocks, the benchmark itself, other asset classes. And typically, our companies are trading at a 16-17% premium. So the Nifty 500 adjusted free cash flow yield is 2.38. For our universe, it is about 2.07, which means that there is an implied 15-16% premium, which is actually quite reasonable. So for the companies that, for the quality of the companies that we have, we are actually happy to pay even a 25-30% premium, because they are far, far superior than the rest of the universe. And the third step of the strategy is we will maintain an efficient churn and cost structure. So see, idea is that once if we've done point number 1 and 2 well, we bought the efficient stress tested companies at an efficient price, what we will do is we'll completely reduce the portfolio turnover and end up saving on the dealing costs. So today there is a misconception that TER is the only cost that investors pay. That is not the truth. So the reality is that investors also pay something called as voluntary dealing costs. So every time a fund manager makes an unnecessary churn, he's paying costs like brokerage, GST, STT, etc., which are all over and above the TER. So the total cost actually is a summation of TER plus voluntary dealing cost. And we at Samco, along with the active share, we are going to be the first AMC to disclose voluntary dealing costs in India. And our aim is like to run the kind of fund that is Fund B. Today, let's say the industry is running Fund A. TER is 1.7%, voluntary dealing cost, because the average portfolio turnover in the category is about 149%. So as a rule of thumb, every 10% portfolio turnover has a 0.1% voluntary dealing cost. So the total cost for the typical industry fund is about 2.9%. The kind of fund that we intend to run, because our portfolio turnover will be very, very less, it will be sub 10%. So our even if our TER is about 1.8 and our voluntary dealing cost is about 0.05%, the total cost will be about 1.85%. And this difference between 2.9% and 1.85% is 1% of cost saving for the investor. And that 1% cost saving on a year-on-year basis will keep adding to investor return. So, if 1% if you keep compounding over multiple years, that too can become a truly large number. As far as the portfolio construction is concerned, we will invest only in 25 businesses. So it's going to be a 25 stock portfolio, 16 Indian companies, 9 global companies, which will be maintained at a ratio of 65% Indian equity, 35% global equity. So this 65% is actually defined by the Indian Income Tax Act. So because if you maintain 65%, you can still be an Indian fund, and the taxation applicable will be 1 year equity taxation. So after 1 year, if an investor sells, he will be able to get 10% long-term capital gains. He will have to pay 10%. So in order to maintain this as an equity taxation product, 65% is the Indian equity. We will be fully invested at all points of time, and no debt, CPs, hedging, etc. will be done. And see, 25 stock portfolio is very important because You see, this is the risk and the line as far as the portfolio theory is concerned. So Burton Malkiel in his study very clearly shows that, the dotted line is the risk line. Now, as you add number of stocks to the portfolio, the risk obviously reduces. But beyond the 25th stock, the risk actually flattens. When you add a 26th stock or a 30th stock, the risk is not reducing, only returns are reducing. Only the returns will get diluted. So, which is why we are saying 25 stocks is the right balance between diversification and concentration. The risk is also optimized, and at the same time, there is an opportunity for creating significant alpha vis-a-vis the rest of the market. In some, so I'll come to the summary in the subsequent slides. One more thing that we are doing very differently is that we think about Samco Flexi Cap Fund as a stock in itself. So we are setting new records with disclosures. So every quarter we will send a NAV along with the NAV and the fact sheet. We will send what is called as a look-through metric statement, where investors will get to understand what the sales growth of their companies has been, what the return on capital, gross margins, etc., so on and so forth has been. So the idea is that because of this disclosures and understand, investors will get a deeper understanding, and you will be able to help investors manage emotions a lot better in both ends of the cycle. As far as the governance of the fund is concerned, I, in capacity as founder director of the AMC, sit as the chairman of the investment committee. Mr. Umesh Mehta, so I come with about 18 years of experience in the markets. Umesh Mehta, who's our CEO and CIO, comes with over 24-25 years of experience in the capital markets. He is also a chartered accountant and an MBA. Nirali Bansali, she is the designated fund manager for the scheme. She typically comes with a 10 plus years experience. She is a CFA, of MBA finance, and an engineer. And before Samco, she used to work with a US equity research firm called Aranka. Dhaval Dhanani again is a chartered accountant by qualification. He's the overseas portfolio manager. Again, he comes with over 7 plus years of experience. So collectively as a team, we have over 55-60 plus years of experience in the investment fraternity. Everything that I've discussed today, we have also published in something called as the Unit Holders Handbook. And I will request Ritu and the rest of the Nirmal Bang team to share the Unit Holders Handbook with you so that you can go through the strategy in a lot more detail. We've actually tried to detail the exact nuances of the strategy in the book. And coming to the final, couple of things that I'd like to cover. So this is what is most important. What are the 3 big reasons to invest in the Samco Flexi Cap Fund? So the first and foremost, as I said, we typically as a fund will invest only in 25 of the best businesses in the world. And as I said, 25 is a great balance to generate alpha, as well as it reduces risk, and global companies. So I think it's very important for Indian investors to not restrict themselves only to the Indian geography. I'll give you an example. 5 years ago, if you would have invested in TCS, which is India's largest tech company, 1 rupee has grown to 2.5 rupees. So 1 rupee in value grew to about $80 billion market cap grew to $200 billion. Now, on the contrary, if you would have invested in Microsoft, 1 rupee invested in Microsoft has grown to 6 rupees. $400 billion market cap went to $2.4 trillion. Now, everybody of us, amongst us, knows Microsoft, uses their products. So, and there are these lots of global trends that are playing out. So, our idea with the Samco FlexiCap Fund is that we want investors to be able to play a lot of the global themes and trends that are playing out, which is only possible with a mix of an India global fund. Second point is, we are going to be investing in companies with a very, very high growth potential. So it is the only scheme in the entire category, which is 65% Indian equity, 35% global equity with a growth strategy. So there is only one other scheme. So Parak Parik, they run a 65-35 India global strategy, but that is a value strategy. So they are trying to buy basically 50 stocks at 52-week lows, and mean reversion is typically the strategy. In our case, it's trend following. We are looking at high growth names in India as well as the rest of the world. And then finally, it's going to be a truly active fund with a very, very high differentiation. So, our active share will be about 80-85%, which is probably going to be the highest in the category, which means that it's a true differentiated fund and investors get true value for money with this kind of a fund. The second is that, we will have a very low voluntary dealing costs, as I said earlier, which will result in about savings of between 1 to 1.5%, and which will also add to investor performance. Why we are different finally from the rest of the other funds in the industry and less other AMCs? First is that our entire research process is extremely tight, rigorous, with our proprietary stress tested framework. As I said earlier, we will only invest from a universe of 125 companies. Most other asset managers are investing from 4 to 600 stocks, really, because, and they practically, which means that they are owning the whole market. So our process is not buying everything. It's very deep from a research selection point of view. These are going to be truly global companies from US, Europe, Japan, and the rest of the world. So not just US companies, you get exposure. We obviously don't have any Chinese company as a part of the portfolio, but yeah, for the other regions, we do have some exposure that will be taken. It's run as a growth strategy, not a value strategy. It is a truly active fund, not an index hugging fund. As I said, we will not be like a copycat fund where we are just buying the same set of index names. Again, it's going to be a strict 25 stock portfolio. We will not have 50-60 stocks in our portfolio like other funds where, and as I showed you earlier, the moment you have 50-60 stocks, your 50th or 60th stock is less than 0.1 or 0.2% of your portfolio. Even if it doubles, your NAV is not going to move. So there is no point of having these long stock portfolios. So we will have this strict 25 stock portfolio discipline, low dealing costs to add to performance, and pure equity fund. So it's not going to be run like a balanced advantage fund. We will not take cash calls, or it's going to be a pure equity fund. The idea is that if our businesses are compounding at 24-25%, we too will allow, be invested in businesses that can see 18 to 24% price compounding over the next few years. So that is as far as the difference is concerned. The product detail, the NFO has opened yesterday on the 17th of January. It closes on the 31st of January, which is next Monday. The reason why we timed this in such a manner is so that we can start investing from 1st February, which is budget day, which is a very highly volatile period of time. So impact costs are lower and we can buy stocks fairly efficiently. The minimum application amount is obviously $5,000. Minimum SIP is 500. There is only a growth option, no dividend option. The benchmark is the Nifty 500, and there is a 2-year load structure. So please understand, this is an equity product. It is not a balanced advantage fund. It is not a liquid fund. It is not for trading. It is not for short-term investors. If you are investing in this fund, investors have to take a 3 to 5 year view. And we therefore want to discourage people from exiting at short periods of time, which is why the load structure is designed as a 2-year load structure. What I'll quickly do is I'll just quickly showcase a couple of ads from our campaign, which can recap the points that I've tried to make in a few seconds.
मैं हूं एक एफिशिएंट कंपनी, मैं हूं एक इनएफिशिएंट कंपनी। हमने अभी एक नया प्रोडक्ट लॉन्च किया इन जस्ट 30 डेज। हमारा प्रोडक्ट भी लॉन्च हो जाएगा, बस कुछ अप्रूवल्स पेंडिंग है। अगले 4-5 साल में इन्वेस्टमेंट्स में ऐसी इनएफिशिएंट कंपनी से दूर रहें जहां फाइलें बस घूमती रह जाएं। सैमको फ्लेक्सी कैप फंड आपके लिए पैसे बनाए दुनिया की बेहतरीन स्ट्रेस टेस्टेड एफिशिएंट कंपनीज में इन्वेस्ट करने के लिए अपने फाइनेंशियल एडवाइजर से संपर्क करें या विजिट करें samcomf.com। म्यूचुअल फंड इन्वेस्ट।
Just one more that I'll quickly show you.
मैं हूं एक एफिशिएंट कंपनी, मैं हूं एक इनएफिशिएंट कंपनी। ये भाई साहब कौन है? दरअसल मैंने इनसे काफी बड़ा लोन लिया है, तो सब कुछ इनसे पूछ के करना पड़ता है। आपके यहाँ ऐसा कोई? No, we are debt free. इन्वेस्टमेंट्स में ऐसी लोन से दबी कंपनियों से दूर रहें। सैमको फ्लेक्सी कैप फंड आपके लिए पैसे बनाए दुनिया की बेहतरीन स्ट्रेस टेस्टेड एफिशिएंट कंपनीज में इन्वेस्ट करने के लिए अपने फाइनेंशियल एडवाइजर से संपर्क करें या विजिट करें samcomf.com। म्यूचुअल फंड इन्वेस्ट।
So I think that's it from a presentation point of view. Ritu, if you have any questions, we can quickly take a few questions.
Yeah, Jeemit. Thank you so much for giving us a brief presentation on how you are going to manage and your investment philosophy and about the product. So I have few questions in my mind. So first of all, like active share thing, concentrated portfolio and international exposure. do you believe these all factors are going to increase the risk level of this particular product among, flexi cap category funds?
Yeah. So I think not really. As I said earlier, in fact, some of the global businesses that we are buying are far better, far resilient than some of the Indian counterpart businesses that we are investing in. So, the quality of the businesses is a lot better. So that obviously reduces the risk to a large extent. Secondly, as I said, if you look here, 25 stocks, it is statistically proven that if you have a 25 stock portfolio, your portfolio risk will be very minimalistic. And so the risk in a 25 stock portfolio and a 50 stock portfolio is practically the same. So there is no additional risk that we are taking. In fact, but a 25 stock portfolio allows you to take that concentration, allows you to generate much better superior return. So while at the same time minimalizing the risk. So that is the objective of having a 25 stock portfolio, which will reduce. And in general, I think, Ritu, if you understand that the businesses that we are selecting, they are going through a very thorough stress test process, and we are only investing from a universe of 125 companies. Now these companies have, the median company was founded in 1940, so it has survived World War II. It has survived, the partition of India, the global financial crisis, dot-com bubble, Asian currency crisis, and the COVID crisis. So these businesses are some of the strongest businesses in the world. And to that extent, the nature and the characteristics of the business itself is low risk in nature. So to that extent, I don't think that any of these things add to risk. If at all, they reduce risk and improve opportunity to perform better.
Okay, so Jeemit, have you done, because this is a all model based kind of, I would say, the investment philosophy. So have you done any kind of a back testing where we can see, even in the recent COVID times, when we can see the drawdown of this particular strategy?
Yeah. So typically, this is the backtested result for the portfolio for the past since 2010 January, and this is on a monthly basis. So now, if you see broadly, the outperformance of these businesses has come in. So out of 140 months, if you take the monthly periods, 95 months these businesses have outperformed. They have underperformed in the balance 45 periods. But the key is, when they've outperformed by a margin of 3.72%. When they've underperformed by a smaller margin of negative 2.8%. And because of that, the average outperformance is about 1.62%. So, on a monthly basis. So this has been very well backtested. But idea is that obviously backtests come with their own challenges and restrictions. But principally, the difference is that the Nifty is at 10-11% return on capital employed. We are at 24-25% return on capital employed. Over the long term, the stock price is going to mirror the underlying return on capital employed, and that is the difference that we are essentially trying to capture. Actually, I think there is one question in the
Chat box
about the
yes,
cap.
yes, I will take it forward. Yes, yes.
So as far as the cap bias is concerned, Nagesh and Erola both, it's a true flexi cap in the truest sense. So there will not be, so broadly about 40-45% will be large caps, 40-45% will be mid caps, and about 5 to 10% odd will be small caps. So it's going to be a true flexi cap in the truest sense. And the important factor also is that, see, please understand, the market capitalization, when we are looking at from a global context, what may appear to be a large cap company in India is actually a mid or small cap company in the world. So $50 billion company in India will be a very large company, but in the US will probably be still a mid cap of sorts. So it is important to take that into consideration as well.
Right. So I think one more question from Irola, that when AUM grows in future more than 5,000, which we are, I think, the Samco is targeting as of now, will you able to maintain same expense ratio?
Yeah. So see, as far as the expense ratio is concerned, that is pretty much slab wise, which there is a SEBI slab wise expense ratio calculation. So we will be following that same calculation. But what is different is that the portfolio turnover that I spoke to you about. So the voluntary dealing cost, that will continue to be low, even if it's a 5,000 crore portfolio or 10,000 or 20,000 crore. So to that extent, the total cost, which is a summation of the TER and the voluntarily dealing cost, we will be able to manage. I don't think that is going to be a challenge. In fact, as the AUM goes, the cost will actually start coming down because the slab-wise cost will also come down.
Good. So one more question on the, yes, Erola, I think as Jeemit also mentioned, there would be 65% into Indian equities and remaining in, in global. So Jeemit, on the global side, if we'll talk about, so what kind of countries you are covering in your universe, and what kind of stocks as of now are coming up?
Yeah. So I mean, if you see the screen, we are covering practically all the geographies. So we will be looking at countries. So if you look at our 85 stock universe, which is global, about 30 odd companies are American companies. 25 odd companies are European companies. We have about 15 odd Japanese and rest of Asia Pacific companies as well. So it's going to be a mix from all these geographies. It's not just US. So the third, and obviously we will disclose the portfolio along with the first fact sheet disclosures that we make. But broadly, some examples of the kind of names that pass our stress tests we have discussed during the course of the presentation. Where we covered names like Novo Nordisk, a Facebook, a Microsoft, or Intuit, or an Nvidia. These are some names these are examples as to what are the characteristics of the kind of efficient companies that we look for.
Okay, so Jeemit, I think people are, interested to know your stress criteria, if you can help them to understand.
Yeah, so typically, I mean, the criteria from a fund point of view, I'll just quickly go back to our core. See, yeah. So these are the core 6 criteria that we typically look at. And as a fund, when we look at 25 names, so if you see the right side of the chart, it's called something called as a spider chart, which puts it up on a score as to what is the stress tested result of each of the businesses that we are investing in. And typically all our 25 companies, all which are practically going to be the subsidiaries of the fund, really are going to pass these 6 facets, and consequently the fund will also do the same. So I think to that extent, we will, as a fund, pass the stress test for sure.
So, Jeemit, is there any kind of a exposure, any kind of a leeway to include the new businesses? Because I believe the model doesn't, will take it the new companies, or will run through your model will run through the new companies.
Yeah. So even new age companies, for that matter, Ritu, we will be able to invest in those businesses because, see, by definition, if you see the adjusted return on capital employed that we look at, when we define an efficient company, we look at not only the accounting ROCE, but we look at, see, basically these new age companies, what do? They make capital expenditures through the P&L. So they incur expenditures on brand and advertising, marketing, or they incur R&D expenditures, or they are paying, investing very heavily in technology and software. So what we do is we adjust for these 3 expenses, and after adjusting for these 3 expenses, we try and calculate what is the true earning of the company from a gross margin and a contribution margin point of view. And then we calculate the return on capital employed. So a lot of new age businesses, even from a global standpoint, do pass our stress tests. But, from an Indian standpoint, there are good Indian businesses that are newly listed new age companies, but the price is very inefficient. These are prohibitively expensive. The valuations are not reasonable in these businesses, and therefore they may or may not form a part of our portfolios.
So again, coming back on the risk part, as you said that international equities will be a part of this fund. So again, the kind of a risk associated with the international investing, like currency and geopolitical risk. So these risks, I believe, will be a part of this particular product, and that probably is taking this product a step ahead in terms of risk.
So actually, what again, Ritu, To the contrary. Really, we have a very false sense of perception that because you are investing only in Indian companies who don't have risk. Even if you look at majority of the Indian companies like a TCS or an Infosys, TCS सिर्फ बोलने के लिए Indian company है. For all practical purposes, it's a global company because 90% of all its revenues come from outside the world, outside India. Similarly for Infosys, etc. So these are truly global companies that are making revenues from across the world. And the same amount of risk is there for a TCS as is for Microsoft, because even Microsoft, it is only listed in the US, but it does business pretty much in the whole world. So we are not taking any country specific risk. As I said earlier, we are not going to be investing in China or Turkey or Brazil or Russia or any such. We are actually investing in companies that are truly global, and if geopolitical risk comes for and affect our companies, be rest assured, every company in the world will have an impact. So it's not going to be restricted to just the businesses that we are invested in.
Oh, so thank you, Jeemit. I think that's all from my side in terms of questions, and any which ways you have explained well with the pointers given to our sales team that you can look forward, or that how differentiate this fund in terms of international exposure, whether it's a international exposure or a growth strategy, or not an index hugging kind of a portfolio. You will get it or diversified, though it's not a it's a very concentrated portfolio, but you will get a diversification across globe, across market cap and the stock and sector wise. And yes, definitely a low dealing cost or low cost kind of a culture, or the theory you have explained. So that is something new for the investors point of view. I am sure, because of generally the investors or the RM look forward for the TER. What is a TER? This particular cost people are not aware about. So how many times fund managers churn the portfolio, so there is also cost involved in that front. So thank you, Jimit, and I just wish good luck to you and your team. And I believe the target you have kept it to garner it, this particular fund you will achieve in this. Thank you so much.
Thank you so much. Yeah.
Thank you, participants. Looking forward for your support in this particular fund.
Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.